Hello, and thanks for joining this webinar on improving pricing power aimed at moving B2B SaaS companies from chaos to clarity through a structured, data-driven approach. Quick intro to me. So I'm Ayon Bhattacharyya, CEO and founder of Spurt, and we work with disruptive B2B SaaS and tech companies to help them scale revenue, reposition value, and optimize their pricing strategies. Over the past 4.5 years, we've helped over 15 SaaS businesses globally across health tech, ed tech, compliance software, job management, and workflow automation software, achieving on average 28% improvements in their MRR, LTV CAC ratios, taking it from 3:1 to 8:1, and taking NRR, net revenue retention, from sub 100 to over 120%. Whilst elevating sales efficiency, moving them up market, and successful expansion into new geographic segments. Prior to this, my pricing background spans over 16 years, working with companies such as TradeMe, Telefonica O2, News Corporation, Equifax, and British Airways. My passion stems from helping SME companies that often have the greatest need to improve their pricing capability but lack the resources and budget to hire internal pricing teams, or large consultancies like Simon Kucher, LEK, or McKinsey. Our goal is to democratize pricing expertise, making it available to those who need it, not just large corporates with multi-million-dollar budgets. In terms of what I plan to cover in this webinar, firstly, we'll take a look at major trends influencing the SaaS and tech landscape in 2025. Next, I will give you a brief intro into pricing power and why it is so important. And I'll share with you the 4 levels of pricing power that apply to any business. We will discuss what good looks like versus some common traps that companies fall into. The icebreaker activity will help you to understand the power of context and framing value in a way that resonates with different customer cohorts. Following that, I will take you through some of the common pricing challenges that I see SaaS companies struggling with. Finally, I will show you a structured, data-driven approach that successful businesses adopt to achieve long-term profitable growth whilst gaining market share, rather than scrambling for growth through guesswork. I also have a case study for you that illustrates how this structured approach has helped our clients to achieve better outcomes and measurable success. Okay, so let's jump into it, shall we? Let's begin with reviewing some studies conducted by OpenView, Simon Kucher, and Revenera. The data shows that shockingly 52% of SaaS companies have not tested or piloted their pricing prior to launch. This is a major concern, as pricing and packaging are a critical part of your value proposition. Would you launch a new product without extensive market research, UAT, customer feedback loops, beta testing with a diverse group of users, and clarity around product market fit? It should be no different for new or revised pricing and packaging strategies. Furthermore, only 36% of companies indicate their pricing is totally aligned with customer value, which I personally feel is an optimistic figure. But this means at least 64% are not confident that their pricing is aligned to customer value, which presents a significant opportunity to capture money being left on the table, whilst improving deal velocity, reducing churn, and improving overall customer sentiment through deeper value discovery work. 44% lack insights to monetize their most valuable features, which, aside from the missed revenue opportunities, presents a significant missed positioning opportunity, particularly given how saturated and competitive this space has become over the past decade. From the buyer side, we see that they prefer usage-based pricing models, flexibility, transparency, and a clear demonstration of value early in the journey. No big surprises there, and we're already seeing a sizable shift from SaaS companies towards hybrid and usage-based pricing models, given the greater perception of fairness and alignment to value. Whilst the rise in software budgets is positive news, prospects are often being benchmarked. They're often benchmarking 10 or 12 software providers as part of their procurement process. And so the need to communicate and sell value effectively has never been more critical. As the SaaS market has become more saturated with many players all competing for customers' attention, CAC has significantly increased by nearly 70% over a 5-year period. Add to this the rising costs of AI, particularly for advanced queries, which impacts cost to serve and means that unit economics can quickly become unsustainable without the right pricing model. This trend really speaks to the necessity of focusing on targeted acquisition based on your ICP, but also a shift in focus toward retention and monetization. Coupled with rising costs, demonetization of the SaaS space due to freemium offers and intense competition have led to a margin squeeze. This graph really shows the extent to which these factors impact on customers' willingness to pay in 2025. This data from Price Intelligently shows almost a 4-fold decline over the past 5 years, which illustrates the importance of a needs-based analysis, a deep understanding of buyer personas, and subsequent value creation. The most common objection to price increases from businesses is a fear of losing customers. But how rational is this fear? Research shows that there is marginal resistance to price increases from 3% all the way up to 15%. The bars indicating perceived success represent negative customer reaction, from 1 being severe to 5 being minimal. And as you can see from the data, the vast majority of SaaS companies are underpricing, and so increasing prices only closes the gap on unrealized revenue potential from value not being captured. Pricing too low impacts how your potential customers perceive the value of your product or service, which is also known as price signaling. Some customers may even have concerns about the sustainability of your business if you are charging way below the value that you deliver. And it is not unreasonable for them to take this view, given that underpricing impacts on a tech company's ability to raise capital and reinvest into improving their proposition. Customers of B2B SaaS companies in particular invest in long-term relationships and initial setup or integration costs, so they will expect you to charge a fair price to remain a viable business. If you are easily winning customers with little or no pushback, it is likely a sign that you are leaving money on the table and need to review your pricing strategy. It is healthy to lose some price-sensitive customers so that you can focus resources on attracting and retaining those customers that truly value your proposition and are willing to pay a premium for it. The principle of pricing to attract your ICPs is key when it comes to positioning and setting pricing strategy. Okay, so what is pricing power and why is it so important? Pricing power is defined as a company's ability to raise prices without losing customers or seeing a drop in demand. Or put another way, a company's ability to charge the price that it deserves for the value that it delivers. Value is always in the eyes of the customer, and value perception relative to competitor alternatives is what drives pricing power. Achieving strong pricing power does not only generate sustainable cash flow to fuel profitable growth, but it is also the #1 factor that investors look for and the most significant driver of higher exit valuations. Think about what happens when the price of milk or bread is £1 higher at one supermarket versus another, or petrol is 10p more at one gas station versus another. You switch because these products are perceived as generic with little or no differentiation. Companies with weak pricing power constantly face downward pressure on their prices relative to those with strong pricing power, such as Netflix or Salesforce, who consistently raise their prices by 10, 15, even 20% without losing customers. In every market, we can identify 4 levels of pricing power: cost chasers, market prices, value conquerors, and price optimizers. Perhaps as a cost chaser, you're working out your costs and adding an arbitrary margin. If you're a market pricer, then you would look at your competitors' prices and set yours similarly. Maybe you're just going with your gut. Both of these approaches can be profitable, but both leave money on the table given that neither of them consider differential value or willingness to pay. The most profitable SaaS companies strive to become value conquerors and price optimizers that put customer value at the front and center. They are driven by data and design packages that align with their customers' purchasing and usage habits. Operating at a level 3 or 4 does not mean that you are ignoring your costs and competitors' pricing, but rather that these are a benchmark for prices that you can set based on segment value and willingness to pay. Product innovation is part of the DNA of value conquerors who strive to differentiate value and price across their customer base with a sophisticated level of data-driven segmentation. To achieve the coveted status of price optimizer, SaaS companies will have incorporated everything from previous levels, implemented continuous price optimization processes, prices that vary by segment, pricing engines that drive automation, and adopted differentiated value selling. At this point, I invite you to take a moment to evaluate where you might sit on this pricing power scale and share your thoughts in the comments below. I would like to think that there are very few SaaS companies that operate at the cost chaser level. This is so ineffective because your customers do not care about your costs. They only care about the value that you generate for their business. However, many SaaS companies often get stuck at the market pricer level and struggle to move to value conqueror and beyond without seeking out pricing expertise. Guessing is by far the most common flawed approach that I see amongst early stage SaaS companies. Costs plus an arbitrary margin is the same as guessing. What are the chances you are landing on the optimal price point? You are either underpricing some customers and leaving money on the table, or overpricing others, resulting in poor conversion and churn. Copying competitors is also pot luck, as you have no idea if they have taken a scientific approach, or more likely, they are just guessing. Plus, your solution is not identical to theirs, is it? Assuming it is better, you are leaving a ton of money on the table this way and commoditizing your solution. Because underpricing also impacts how your customers perceive your products or services. So, all of these approaches are flawed. They're essentially finger in the air or throwing darts blindly at a dartboard, hoping something might stick. So hopefully we've established that pricing is not picking a number out of a hat. Pricing is the process of understanding how different groups of customers value your solution, how to charge for those benefits, and iterating price points over time to get closer to their optimal willingness to pay. The process needs to be ongoing, never set and forget, since market dynamics and value perception are ever changing. Your customers are always evaluating your proposition and its price against alternatives. Every tweak of your pricing design or price points is an opportunity to learn through the impact. Okay, we've covered quite a bit so far, so let's take a breather. Here's a question for you. How much would you pay for air? Let's assume I bottle the air in this room and try to sell it to you without any further context. Most of you would probably look at me as though I'd lost my marbles and offer me nothing for it, which is fair because air is all around us, and so we perceive it as a commodity. But what if we were to change the context? What if you were scuba diving, you're unable to surface due to sharks circling above, and you're running out of air in your tank? How much would you be willing to pay for air in this situation? Now you would likely pay any amount of money for that tank of air, since your life depends on it. This is the power of context-driven pricing and positioning. Understanding that the value that your customers place on your products varies significantly based on their use case and unique set of circumstances. Okay, let's take a look at 5 common challenges that I see SaaS companies struggle with. 9 years ago at a SaaS stock conference, Patrick Campbell coined the term acquisition addiction. And nearly a decade on, we are seeing so much over-reliance on acquiring customers whilst neglecting retention and monetization. The glaring flaw in this approach is growth inefficiency, given the increasing costs of acquisition. A few slides ago, we discussed the margin squeeze that the SaaS industry as a whole is facing. Well, this is where companies that take a more balanced approach to their growth levers succeed, ensuring that they retain and monetize their existing customers rather than simply chasing new ones, which I like to call leaky bucket economics. In a Price Intelligently study conducted several years ago, it was found that monetization is 4 times more effective as a driver of profitability relative to acquisition, and twice as effective as retention. Monetization allows you to grow smarter, not just faster. The second challenge is undervaluing your offerings. When you undercharge, your sales reps might be walking around with big smiles on their faces, but your board, your investors, your employees, and even your customers long-term will not. Why? Because pricing creates perception around value and quality. Your best customers have invested money in terms of setup and integration costs and time into the relationship, so they're expecting you to charge in line with sustainable unit economics. They are expecting you to reinvest profits into further value creation, which ultimately generates greater outcomes for them. It is essential to perform a win-losses analysis, set up customer feedback loops, perform willingness to pay surveys to figure out if your pricing aligns with your customer's value perception. Implementing a pricing governance or discount managing process helps to set guardrails and protect margins by avoiding unnecessary revenue leakage whilst enabling sales agility. The saying, one size fits all, fits none, is very pertinent here. Going back to first principles, customers value choice and flexibility. The needs of SME customers are not the same as enterprise customers. Neither is their level of affordability. Great packaging creates a ladder of value which serves as a natural upgrade pathway to customers as their needs increase and become more sophisticated. The more price points that you create along the demand curve, the more revenue you can capture from different customer segments. But too many price points shown to customers results in the choice paradox. If they can't make a decision quickly, then you will probably lose them. Take LinkedIn, for example. The customer self-selects their use case, i.e. job seeker, business, sales, or recruiter, before you get to see pricing options, which are then further differentiated. The simplest and best place for SaaS businesses to start is with a good, better, best model, with modular add-ons that are high value for some customers, but don't fit easily into the packages. This next challenge is relevant to any business. Customers care about benefits and outcomes, not about your features, as much as your engineers would have you believe otherwise. These features are simply a means to an end or outcome. When sales, marketing, and customer success teams lose sight of this, and companies don't perform the required level of value discovery and communicate benefits, customers won't buy. And even if they do, they will lean towards the cheapest options. The beauty of nailing this challenge is that you as a business get to influence how your customers think about value through how you tell the value story. Context is everything, and positioning helps to improve value perception and ultimately willingness to pay. This final challenge is pricing inertia and misalignment to business objectives. Static pricing that fails to adapt to shifting market dynamics and changes in value perception soon end up working against the business. This usually happens when there is no single ownership or accountability for pricing strategy, and instead it gets shared across multiple areas, often neglecting it. If businesses are not strategic about pricing, then it defaults to becoming reactive and ad hoc, a tug of war between stakeholders with conflicting objectives. When there is no alignment around value and no monetization model to support expansion, sales teams end up simply chasing new customers at all costs. Product builds more features, but not necessarily the ones that customers truly want or need. Customer success turn into customer support. Finance attempt to protect margins, but have no structured process for doing so. And the CEO or founder gets caught in the middle, ultimately having to make decisions without the necessary data and insights to validate them. The tug of war between business functions leads to customer confusion from conflicting messages and inconsistent pricing decisions. I would love to know what your top 2 or 3 challenges were from the 5 that we went through, which are up on the screen there to refresh your memory. Please just let me know in the comments below. Now that we've covered some of the common challenges that SaaS companies face, let's take a look at a more structured and data-driven approach that successful companies can take. The first step in any pricing transformation project is to determine the North Star. What are the business goals and desired outcomes? How do you want to be perceived by your target market, i.e. positioning? Specifically, what customer attributes define your ideal customer profile, and in what context is your solution most valuable? Next, we need to replace gut feel or internal bias with data-driven insights such as usage data, value data, willingness to pay, and competitor insights, and then build segments around different use cases and personas based on the complexity of their needs. This then provides the foundation for packaging that aligns to value drivers and scales as customer needs increase, with premium prices supported and evidenced by greater outcomes such as revenue generated, cost savings, or risk reduction. Add-ons or modular pricing provides further upsell opportunities along with pricing metrics that monetize usage. Market testing helps to manage risks and provides business leaders with the confidence to take the leap of faith and launch the new pricing model and packaging to the wider market without fear of losing customers or getting backlash. Before going out to the wider market, sales and customer success teams need to be enabled with the appropriate value selling playbook, leveraging usage data and incentivized in the optimal way. This is probably the most crucial step in successfully executing any pricing transformation, as without their buy-in and the right training, even the best strategy will fail. Governance processes and discount guardrails ensure that new pricing and packaging is integrated into the sales approach, safeguarding margins whilst enabling agile selling. Finally, performance of the new monetization model needs to be tracked and monitored and pivoted where necessary to ensure successful business outcomes. This is not a closed loop set and forget activity, but rather a continuous process that evolves with shifting market conditions, changes in value perception, and adapts to new segments or geographies, among other factors. So let's take a brief look at how we put this into practice for one of our mid-market SaaS customers. Spend from their existing customers was declining. Churn was on the rise due to lost product market fit in certain segments. This SaaS company was unable to onboard new customers fast enough to stop the bleed, and so revenue started sliding backwards. After approaching us, we returned to first principles, focusing on redefining ideal customer profile, determining value attributes and specific segment needs, exploring different use cases, and revising the segmentation model accordingly. Revising the packaging to create a ladder of value across these segments, we established a scalable revenue model with pricing levers aligned to usage, engaging with customers to build value models and establish ROI. Spurt then helped the client to market test the new pricing and packaging generated from the value discovery work and willingness to pay surveys. We then implemented KPI dashboards to monitor performance, refining and iterating the monetization model as necessary. The outcome of this was that ARR increased by 40% in 9 months. NRR, net revenue retention, went from negative growth to over 110% in that time. Churn decreased substantially, and our client was also able to attract higher value customers as a result of the pricing transformation work, resulting in improved ARPU, average revenue per user, and customer lifetime value. So here's a recap of the key areas that we have covered in this webinar. We went through some of the key trends such as the margin squeeze impacting the SaaS space, buyers' preference for flexibility and transparency, and a huge opportunity for companies to get better understanding value and market testing their pricing before going out to the wider market. Hopefully, you now have a better understanding of pricing power and its importance, along with the 4 levels of pricing power that apply to any business. You also understand the need to move away from guesswork, cost-plus pricing or matching competitors, to a more strategic, data-driven approach that is less reactive or ad hoc. We have covered 5 common challenges that SaaS companies struggle with, and our Profit Plus framework, which enables businesses to overcome these challenges. We've also looked at been through a case study that illustrates the outcomes that you can expect to achieve by following a more structured data-driven approach, such as Profit Plus. Lastly, I'd just like to thank you for watching this webinar. I hope you've enjoyed and got value from it. If you would like to discuss any of the topics raised today or anything else specific to your business further, then please get in touch via any of the channels listed in this slide. If you would like to explore how Spurt can help you to achieve similar results to those of our clients, getting you on the road to profitable growth and higher valuations, then please feel free to book a call using the Calendly link in the slide. Thanks again for watching and best of luck on your journey to success.